I hope you can hear me now. Working on the technical issue. Okay, you still cannot hear me. Okay, just a few moments.
Ima,
Yeah.
we can hear you now. Can you hear me? Here's the problem. You don't remove it. Don't remove it. Till that. You remove it and that's why people cannot hear you. Leave it. Or do you want to show yourself? If you want to show yourself, just pick this. So you can continue. So if you talk, I will hear. I will get. I mean, I not you can move your left. But if you don't have this, you will I will hear. Then I will hear, but I will. Anyhow. Torí àwọn yẹn ṣe ẹnìbọ̀ tó sẹ́yìn ní ìgbẹ́ ẹ̀yìn so that we do get it in that. Only thing, I don't get this one. They are saying, yes, you and they make a lot forward down.
Okay, so we can move on now. I was actually doing an analysis of I've really said a lot that we did not hear. I was talking about standard cost and I said a standard cost is a predetermined cost. It is like an estimated cost, and it's it's like knowing the cost of a particular item before and before going to the market to buy it. Now I was not saying that we have a standard a predetermined cost, and that standard cost or an estimate you've made does not translate or does not amount to the actual cost. Now when you have such case, you have to compare your standard and your actual to get a variance. Now when you get the variance, when you want to further investigate that variance is what we call variance analysis. Now that variance you have gotten, we want to know, is it a favourable variance or adverse? How do you know if a variance is favourable or adverse? We know a favourable variance by comparing the actual result and the expected result. If the actual result is more than the expected result when it comes to cost now, the basis and rationale for arriving at the type of variance it is depends on if it is a cost or if it is an income or sales. Now if it is cost related variance, when the actual result is more than the expected result, we say it is an adverse variance or unfavorable variance. Also, if the actual is less than the expected result, we call it favorable. Favorable. We call it favorable. We call it favorable. However, when it comes to sales, the rationale and the basis for arriving at the type of variance differs a lot. In this case now, if the actual is more than the expected, we say it is favorable. When it comes to sales, income, anything that relates to money coming in, we say it is what? Favorable. If the actual is more than the expected, and if the actual is less than the expected as regards sales now, we say it is adverse. We say it is adverse. So I was trying to explain that how do we know the type of variance to compute? Because in a situation whereby I can just come up and say calculate all relevant variances, we might not know the variance to calculate. And I said we start with what are the elements of cost? What are those things that constitute elements of cost or that constitute our total cost? Now we have material, labor, overhead. I don said overhead is divided into variable overhead and fixed overhead. Variable overhead and fixed overhead. Now I now picked from material. I now said for material cost, what are the two factors that affect material cost? Price and quantity. Two factors that affect material cost are basically price and quantity, because when you multiply these two together, they will be the one to give you your material cost. Then if this I want to give you material cost and your actual material cost is different from your standard material cost, then it can be traced to either price or quantity or both. So we now have to split these factors. We now have to split these two factors separately to be able to know which one has given us a variance and what kind of variance have we obtained from the element of cost. In this case now, the first thing we are looking at is what? Is material. Is material. So here now, I'll look at it and say price. What is the formula for price variance? I said material price variance is a function of standard price per unit. Standard price per unit, which you are going to get in the standard cost card, minus the actual price per unit. Actual price per unit. When you get the difference, you multiply the difference by the actual quantity that was purchased. Now, there are possibilities that in that same question, in a question, there will be material purchased and material consumed. Anything that relates to the price here, you use material purchased, actual quantity purchased rather, actual quantity purchased. Now we now move to material usage variance. For the material usage variance, the formula is the standard quantity per unit given in the standard cost card. Standard quantity per unit given in the standard cost card multiplied by the actual quantity produced. Actual quantity produced, because we want to look at it that if you are saying by standard we should have used like 1 kg or 1 teaspoon of sugar to produce an item. If you want to look at it by standard, now say, oh, we produce 100. If we have to go by standard, how many should we have used? That's what we are trying to get here. We are trying to say, oh, in producing a particular item, we need 1 teaspoon of sugar. We now produce 1,000 units of that particular item. If we have to go by the standard, how many teaspoon of sugar should we have produced, considering the fact that we produced 100 and 1,000? So it is going to be the standard quantity of teaspoon sugar we need per unit multiplied by the actual quantity. Then we are going to have the actual quantity used, actual quantity consumed, actual quantity consumed. When we get the difference, we multiply it by the standard price. When we get the difference, we multiply by the standard price. we get the standard price. So now this material usage variance also can be further divided into material mix and yield. Can also be divided into material mix and yield variance. But don't worry, we'll come back to that. We'll come back to material mix and yield later. Come back to material mix and yield later. Now I have done material. I will now say labor. Labor. What are the two factors that affect labor cost? Labor cost. What are the two factors that affect labor cost? And what are the two basic variance that we prepare under labor? We have the rate, we have the rate and hours, which is measured in efficiency, which is measured or efficiency. So I'll come here and say what is the material, what is the labor rate variance? Labor rate variance. The formula is similar to that of labor, that of material, just that the nomenclature changes. We have the standard rate per unit given in the standard cost card minus the actual rate. When you get the difference, you multiply by the actual quantity, actual hours paid for, actual hours paid for, actual hours paid for. Now, actual hours paid for. Then for my labor efficiency variance, we have the standard hour per unit, standard hour per unit multiplied by the actual quantity, actual quantity minus actual hours and actual hour worked for, actual hour worked for. Then when you get the difference, you multiply it by the standard rate. Now, in this case now, you see that we have actual hours paid for and actual hours worked for. The difference between actual hours worked for and actual hours paid for is what we call idle time. Idle time. What we call idle time. Now, actual hours worked for is actually the productive hours. Is actually the productive hours, and that is the reason we are using it under efficiency, because we need to really know the how many hours you've worked and not how many hours you've been paid. Now, there are you will see that while we were trying to do to set up this class, there were some technical issues. Now, if you look at it, if I am being paid, you will see that if I've worked for 4 hours, I didn't really work for that 4 hours because there were some technical issues that I did not, and I was not able to go on with the class. That time can be seen as what? As idle time, because they are going to, I'm taking for example now, I'm going to be paid 4 hours, but I didn't work for 4 hours. I worked for maybe say 3 hours, 30 minutes. But because it wasn't my fault, it was not within my control, I had to be paid that money. So the difference between these two can be seen as what? Idle time. And idle time many a times is usually adverse. Idle time many a times is usually adverse. The only situation whereby you can have a favourable idle time is when you have a budgeted idle time inculcated in the standard cost card. When you have a standard idle time rather inculcated in the standard cost card, it is then you can even think of or having the thought of having a favourable idle time. But in most cases, idle time is usually adverse. And how do you get your idle time? Your idle time is the difference between your actual hours paid for and actual hours worked for multiplied by standard rate. So it is going to be the idle time multiplied by idle time multiplied by standard rate. Idle time multiplied by standard rate. So I move on to variable overhead. Variable overhead. Oh, we are still on call. So we move on to variable overhead. So for variable overhead, we have two variances we compute under variable overhead, which is efficiency and expenditure. Efficiency and expenditure. Efficiency and expenditure. So for efficiency, let me say expenditure. Expenditure, it is standard rate of variable overhead multiplied by minus rather actual rate, you get the difference, then multiply by hour actual hours. Now, if you are giving actual hours of variable overhead, you use actual hours of variable overhead. But if you are not giving anything relating to hours under variable overhead, what you just do is you will take the labour hours as hours of variable overhead. You will take the labour hours as what? Hours of variable overhead and fixed overhead if you are not giving. Now, don't forget that according to the explanation we had earlier, we said we have actual hours paid for and actual hours worked for. In a situation whereby you have these two, which of the hours are you going to pick? After you've used your actual hours worked for under labour, Every other thing you'll be doing as regards labor, if you are going to be using the same hours as labor hours for variable overhead and fixed overhead, you are going to take the actual hours worked for. Actual hours worked for. Actual hours worked for. Worked for. That is it. Then for expenditure, for expenditure, sorry, for efficiency rather. For efficiency, we have standard hour, standard hour of variable overhead per unit multiplied by the actual quantity produced. You will see that this thing follows the same pattern. If you can study it well, it really follows the same pattern. Then you have the actual hours. Actual hours. Get the difference? You multiply by and you multiply by the standard rate of variable overhead. That's it. So number next, as regards cost, the last one we have as regards cost is fixed overhead. Fixed overhead. Fixed overhead. Now, for fixed overhead, we have broadly expenditure and volume. Expenditure and volume. So for expenditure, it is standard cost of fixed overhead. Standard cost, no rate now, standard cost of fixed overhead multiplied by budgeted quantity. Budgeted quantity multiplied by budgeted quantity give you the standard cost minus the actual cost of fixed overhead. That is it. Then for volume, volume can be computed using two methods. In fact, volume is very it's somehow, but it is very simple, and I'll make it clear. Now, and this is it. You get the budgeted quantity minus actual quantity multiplied by standard cost. Ican does not use this one. Let me just stick to most of this class. Let's just stick to standard hour per unit multiplied by actual quantity produced minus standard hour per unit multiplied by budgeted quantity. You get the difference, then you multiply by the standard rate. Now, this volume can be further divided into two. It can be further divided into capacity capacity and efficiency. So here is the take. If you are going to prepare volume variance, you don't need capacity and efficiency. And if you prepare capacity and efficiency, you don't need to compute volume. When you prepare volume variance, you don't need to prepare capacity and efficiency. And when you prepare capacity and efficiency, you don't need to prepare volume, because the answer we are going to get in our volume here is still going to be the answer we are going to get when we add capacity and efficiency together. So what is the formula for capacity? I used to tell people capacity is very very simple. You will say actual hours minus budgeted hours when you get the difference, you multiply by standard rate. That's it. Then efficiency is standard hour minus actual hour. You get the difference and you multiply by standard rate. That's all. That is all. Any questions so far? Any question? Any question? Okay. In the absence of no question, I'll move to the last stage, which is sales. Sales. So two things affect my sales. It is the volume I am selling in form of the quantity, and the price I am selling each one of them. The price I am selling each one of them and the quantity. So now we go again. We say, what is the formula for volume variance? The formula for volume variance is simply budgeted quantity minus actual quantity sold. When you get the difference, they will multiply by standard profit. Now, we are going to use standard profit if our costing system uses absorption costing system. I explained yesterday. I explained what absorption costing system is. We are going to use standard profit if our costing system is what? Absorption costing system. If it is marginal costing system, what we are going to use is going to be contribution, standard contribution. And I told us several ways to get contribution yesterday. I told us like 3 to 4 ways to get contribution. I said sales minus variable cost, fixed cost plus profit, and fixed cost minus loss. So that is that. Then for price, the formula is going to be the standard selling price minus actual selling price. You get the difference, then you multiply by the actual quantity sold. Actual quantity sold. Actual quantity sold. So this is basically the formula for basic variance, and this is what we are going to be testing for the next question. Now, that question has, let me see, let's analyze the question together. Let's analyze it together and see. Okay, you said I should recap the idle time. I said the idle time is the difference between the actual hours worked for and actual hours paid for. Now, actual hours worked for is the productive hours that is being put into producing, while the actual hours paid is the hours you be paid for the labour, having considered both idle time um and the productive hours. Now, there are possibilities that when you are trying to produce an item, there might be machine breakdown, there might be material might get finished in the course of producing, and the process of you trying to get a means to resolve the pending issues at that time, the labourers and or the guys working will not be doing anything at that time, but because it is beyond their control, it's not their fault, you have to pay them. They are there doing nothing, they are not productive, but you are paying them. So trying to differentiate between the hours paid for and hours worked for is what lead us towards the idle time. And I said the idle time is adverse mostly adverse. The only case you have a um favourable variance as regards idle time is when idle time has been inculcated in the standard. So when you now compare the actual idle time to the standard idle time, there are possibilities that you have favourable idle time. Yes, it is possible, but mostly and in most cases idle time is usually adverse. It's usually adverse. So I think I've answered that. So now, if you look at this question now, it's a very, it looks like a big question, but no, it is not big. And yet we are listening. A company manufactures one product and the entire product is sold as soon as it is produced. There is no opening or closing inventories and work in progress is negligible. There is no opening or closing inventories and work in progress is negligible. The company operates a standard costing system and analysis of variance is made every month. The standard cost card for a product widget is as follows. Standard cost card widget, standard cost card for widget is as follows. You say we have direct material. For each unit of widget that is produced, you need 0.5 kilos of material. Now, you need to be able to identify each of these figures. Now, this 0.5 kilos of material is what you need to produce 1 unit of widget. 0.5 kilos is what you need to produce 1 unit of the widget, and each one is sold at 4 naira, which gives you 2 naira per widget. To produce widget now, you need 2 naira to buy material for 1 widget, 2 naira to produce 1 widget. The same thing applies to labour. Labour needs to work 2 hours and they are paid 2 naira per hour, which means to produce 1 unit of widget by standard you need 4 naira. Variable overhead, fixed overhead, standard cost, you have a standard profit, standard selling price. Now, they said The budgeted output for January was 5,001 units. Actual results were as follows: production of 4,850 units was sold for 95,600. Now this question now, e did not give you the selling price per unit, e gave you the sales direct, but you are giving the unit that was sold, that was produced and was sold for. Now this place now looks like, oh, you don't even know what was sold, but you are giving production, but was sold for 95,600, which simply translates to the whole 4,850 that was produced was sold, because they said production of 4,850 units was sold for. So if they had said production of this, then production of 4,800 and quantity sold was this, you are going to have closing stock. But here now, no closing stock. They now said material consumed in a production. Material consumed in production amounted to 2,300 kilos at a total cost of what? 9,008. You are not giving the actual price of material here. You have to divide the 9,008, which is the total cost of actual material, by 2,300. The same thing applies to labor. You have the actual operating hours. Now, actual hours paid for amounted to 8,005. Actual operating hours amounted to 8,000 hours. Variable overhead amounts to 2,006. You will see that you are not giving hours for variable overhead and fixed overhead. Now, like I said earlier, you are going to absorb the labor hours on both the variable and fixed overhead, and you have 2 hours here: actual hours worked for and actual hours paid for. I told you that you are going to pick the actual hours worked for variable and fixed overhead. They now said calculate all relevant variances and prepare an operating statement for January. And prepare an operating statement for January. Prepare an operating statement. So please, I want you to check the question from your end, because I'll be changing the page to so the name of the company is, they say, a company. Our requirement is analysis of variance. So please try and work with be checking the question as you are checking the solution so that we will be on the same page together. We'll all be on the same page together.
Here's your question. Open it.
Okay, so I told us that they might ask us to prepare all relevant variances, which we might not know which one they want, but let's see. We started by saying material, isn't it? Material, under material, we said we have price, and the formula for price is standard price. The standard price given to us is 4. Standard price is $4 minus the actual price, $4. The actual price we are not given, but they said $9,008 was spent to buy 2,300. So what do we have? 9,800 divided by 2,003. So 9,800 divided by 2,003. Now you see that I have, if you check your calculator well, you will see that you have 4.26, 4.26 something. Now, what is the standard quantity? The the actual quantity purchased. Actual quantity purchased is 2,300. So we have the difference. The actual quantity purchased is 2,003. 2,003. This is the standard price, standard price, actual price, difference, then actual quantity purchased, actual quantity purchased. So what's the difference here? So you have about 4.2608 and so on. So what I will just advise you do is just press the answer, just do 4 minus answer. 4 minus answer gives you, it gives you minus 0.2608 and so on. So when you now multiply it by this, multiply by 2003, you have something, you have what? 600, 600 adverse. Why is it adverse? Because my standard price is less than my actual price. The standard price have what predetermine my estimate is less than my actual price by what? By this. When I multiply by 2,300, I have 600 adverse, $600 adverse, $600 adverse. That is that on the material. Now, if you approximate and say 4.2, you will see that when you just do 4 minus 4.2 multiply by 4 minus 4.2 multiply by 2,300, you are going to get 460 instead of 600. And when you now do your reconciliation, you now see that it did not balance, or it's not balancing, because you did not what? You did not take cognizance of the what? Of the approximation. That was the reason I said one of the pitfall of this topic is what? Approximation. Please do well to approximate well. I hope that is fine. I hope that is fine. You can move on. I hope that is fine. So I move on to quantity. For quantity, the formula is standard quantity minus actual quantity. So what is the standard quantity? Standard quantity says they use 0.5 per unit. Now, how many units were produced? They were able to produce 4,850. 4,850. So when you multiply this, what do we have? 4,850 times 0.5, that's 2,425. 2,425. The actual quantity is 2,300. 2,300. And the difference is going to be this. This is the difference. Then standard price. Standard price is $4. Now the difference is it favorable or adverse? Favorable or adverse? It is adverse. Okay, we'll tell we're not using formula. 125 adverse minus 125, because the standard quantity is the standard quantity is more than the actual quantity. No, sorry, it is favorable. Sorry, favorable. Favorable rather. It is favorable because the actual quantity is more, or the actual quantity is less rather actual quantity is less than actual quantity is less than the standard. So when you multiply it, you have the variance. Variance is 500 favorable. So that is that on material. So we have labor. Any question? So it is what? Favorable. So I can move to labor. So labor 2 is divided into labor rate. So for rate, we have standard rate minus actual rate, get the difference, we multiply by actual hour paid for. So what is the standard rate? Okay, somebody will be giving us figure from the one of us will be giving us figure. So I will mute. You can talk now.
Hello, can you hear me?
Yeah, we can. I can hear you.
Okay, good morning, Mr. Emmanuel. Standard rate
What did you say?
is, I said good morning. Standard rate is 2 hours.
Standard rate is what?
Standard rate is $2.
$2. Okay, as given in the standard cost card,
Yes.
$2. And what is the actual rate?
16,800 divided by 8,500. So that's one
Okay,
point
16,800,
divided by 8,500.
8,500. So what would that give us?
1.976465.
So we have 1.9
765.
764. Now, if you look at this question and you say you want to approximate to 2, this also is 2. You are going to get 0 as the variance. You are going to get 0 as the variance. So what do you need to do? As you have gotten it in your calculator, just say 2 minus answer. Just do it like that. 2 minus the answer. Multiply by what is the actual hours paid for? 8,005, right? 8,005.
Yes.
So the difference is going to be 0.0235 and so on. But please, in exam, make sure you are doing the 2 minus answer because it's going to be more than this. When you multiply by 8,500, you have 200 favorable. You have 200 favorable because your standard rate is more than your actual rate. So you have what? 200 favorable. Then you move on to labor efficiency. Labor efficiency is going to be standard hour and actual hour. You get the difference and multiply by standard rate. So what is the standard hour? Standard hour required per unit is what?
2 hours.
2 hours, right?
Yes.
Multiply by how many units were produced? 4,850.
4,850.
4,850. Then the actual hours is what? Actual hours worked for. Actual hours worked for.
8,500.
No, that's actual hours paid for. It's actual hours worked for. Actual hours paid for is the 8,005 without considering that's with idle time. But the actual hours they eventually work for less, that is the one that does not have the productive hours. The productive hours now is
8,000 hours
8,000. So this is going to be 9,700. 9,700. And the difference there
minus
is going to be 1,007
1,700.
multiplied by $2. So 1,007 multiplied by $2 is 3,004.
3,400.
Favorable or adverse. Now you see that your standard hour is 97, which is more than actual hour. As such, it's going to give us what? Favorable. 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 So that is that about labor too. Then you now move to overhead. 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 So a variable overhead rather. Variable overhead first, not just overhead. For variable overhead, the first thing is expenditure, but you can start with anyone you remember first. Expenditure. The formula for expenditure variance is the standard rate minus actual rate. You get the difference multiplied by actual hours. So what's the standard rate?
0.3.
Standard rate of variable overhead is 0.3. Standard rate of actual rate of variable overhead. What is the cost? 2006 abi,
Yes, 2,600.
and they didn't give us the hours. So we are going to take the labor hours, the number of productive hours used by labor for variable overhead, which is 8,000 naira. 8,000 labor hours rather. 8,000 hours.
0.325.
So this one gave us directly is very still 0.325.
325.
So when you get the difference, what is the actual hours? 8,000, right?
Yes.
8,000 and the variance
200.
200. This 200 adverse
Yes.
because the actual rate is higher by 0.25 compared to the standard rate. 200 adverse. Then the efficiency. Efficiency efficiency is a function of standard hour per unit multiplied by standard hour per unit multiplied by actual quantity produced. Actual quantity produced. Then actual quantity produced minus actual hours. Get the difference. Get the difference. Then we multiply by standard rate. So what is the standard hour required for variable overhead per unit of widget?
2 hours.
2 hours, okay, multiplied by the same 4,850.
4,850.
You can see it is following the same pattern. The actual is what? The actual hours worked for
8,000.
8,000. This is going to be 97. This is 8,000. The 1,007 difference. The standard rate is what? 0.3.
0.3. 510.
510. Advance or favorable. This is going to be favorable. Favorable. Because you have 9,007. You're expected to spend 9,007 hours, but you eventually spend 8,000 hours, which means you've saved yourself 1,007 hours. And as such, you are going to do what? Have a savings of 510. Um, Eminoluwa, which of the efficiency is it for variable overhead or for labor? Please kindly indicate so that I can just do that before I move on. Which of the efficiency? Which of the efficiency? So, Temi, I don't know which of the efficiency you want me to explain, but it's still the same thing. The efficiency is just the standard hour per unit given in the standard cost card multiplied by the actual quantity that was produced. That is, once you look at it, that based on our own standard, how many hours should we have used producing 4,850? Do you understand? That is what we're trying to get by calculating our standard hour. We say normally we should be spending 2 hours to produce one widget. We now we're now able to produce 4,850. So the question now is, if we are to go by the standard, we say how many hours should we have used in producing that 4,850? That is what we did by getting the standard hour. Then the actual hours is given to us. Now the actual hours we used, because we did not have any hours that is related to variable overhead, but we have for labor. So we are taking the labor hours which is meant for labor to be the same thing for variable overhead. Now the question now is we have two type of labor hours in that question, which is labor hours paid for and labor hours worked for. Now in this case we are looking at how efficient the labor are and we are going to just take labor hours worked for and not paid for. Do you understand? Do you understand? I hope that answers the question. So let's move to variable overhead, to fixed overhead rather. Fixed overhead. For fixed overhead we have expenditure variance. So for expenditure, the formula is budgeted cost minus actual cost. But how do I get my budgeted cost? My budgeted cost is simply standard cost. Let me split it again. Standard cost per unit multiplied by budgeted quantity per unit. So so now what is the standard cost of fixed overhead? Not standard rate o, standard cost of fixed overhead, and that is the rate multiplied by the hours. What do we have?
7.4.
7.5,
7.4.
7.4. The budgeted quantity is what? 5,001. Then what is the actual cost?
42,300.
20.
42,300.
So 7.4,
740.
37,740.
4,560.
4,560. You will see that your our budgeted is less than our actual. So this is what? An adverse. An adverse variance. So the next thing is volume. Volume. So for volume, the formula is standard hour minus budgeted hour standard rate. So what's the standard hour? Standard hour is 2 times actual quantity produced, 4,850, minus also 2, because our budgeted hour is calculated as standard hour per unit multiplied by budgeted quantity. Standard hour per unit multiplied by budgeted quantity. So we are looking at it that if we are to go by our standard and our own budgeted quantity also, how many hours should we have used in producing? So our budgeted quantity here is 5,001, 5,100. 5,100. This is going to be 10,200. This is going to be 9,700. Standard rate is what?
3.7.
This is 1,850. So this can now be splitted into capacity. Now, the formula for capacity, there is one acronym I used that time. I don't know if you want to use it, but if you're interested, it's just CAPS. So what is CAPS? You just simply say capacity. C for stands for capacity, A stands for actual hour, B stands for budgeted hour, and S stands for standard rate. So what is the actual hour? The actual hour given to us is 9,000, 8,000, right?
Yes.
Projected hour is 2 times 5,001, which is 10,200.
2,200.
2,200. What's the standard rate?
3.7.
Is 8,140. Advance. Then you have efficiency. Efficiency. Efficiency is a function of standard hour minus actual hour divided by standard rate. We've calculated standard hour now. Standard hour is calculated to be 97. Actual hour is calculated to be 8,000 from our previous calculation. The difference is 1,700. The standard rate is 3.7, isn't it?
Yes.
So what is going to be the variance?
6,290.
6,000.
290.
Is this favorable or adverse? This is going to be 97. This is favorable. So when you say 814 adverse. Now here is it. Let me use formula here. Is equals to minus 814 plus 6290. So what it gave us, which is the volume here, 1850 adverse. Let me tell you another method to calculate volume. Or you say, or what is the budgeted quantity?
8,000 and 5,100.
Budgeted quantity is 5001. Actual quantity is what?
4,850.
4850. And the difference is what? Is that not 250?
Yes,
Then multiply by the standard cost,
7.4.
7.5. So when
7.4.
you multiply, what do you have?
1,850.
1850. So that's another method you can use to get whichever one you feel is convenient for you. You can use it. So before I move to price and reconciliation, please, any question? Okay, I was told to explain expenditure. What about the expenditure variable? Which actual hours did you use? The actual hours I use is the productive hours, which is 8,000. I told you that other than the um the labor hours, when we're calculating labor rate, that we use actual hours paid for. Every other labor hours we'll be using is um labor hours worked for, which measures the productivity of the workers, which measures the productivity of the workers. So somebody say, what is the answer you got for fixed overhead expenditure variance? The answer we got, fixed overhead expenditure variance, we got, this is it. That's it. 4,560. 4,560. 4,560. Okay, so Mr. Chris, please explain the volume variance again. So for the volume variance, I said we have basically two ways of solving volume variance. Basically two ways of solving variance. But the two are very simple, but you can pick any one you want. So it's either you use the formula of saying standard hour minus budgeted hour, standard hour minus budgeted hour, and the standard hour is, how do you get the standard hour? Is by saying the standard hour per unit multiplied by actual production, and the budgeted hour is the standard hour per unit again multiplied by the budgeted quantity, budgeted production. You have, so what we're supposed to have is 2,002. It should be 500. So, or you say, what is the budgeted quantity? 5,001. and what is the actual quantity. Get the difference, then multiply it by the standard cost of fixed overhead. That is standard cost of fixed overhead given in the standard cost card. Now, what I now said is if you don't do these two, you can do capacity and efficiency. But if you do capacity and efficiency, don't do volume again because you are still going to arrive at the same answer. So there's no point doing it. They will mark just one of them. So when you use capacity, I made a joke that you can use caps, and caps is where your A is capacity variance, which is equals to actual hour. Actual hour is productive hours given. Since we are not giving the variable overhead hours, we use the labor hours, labor's productive hours. While the projected hour is just the standard hour per unit multiplied by the projected quantity. You get the what? Projected hours. When you get the difference, you multiply by the standard cost per unit for fixed overhead. And you get your capacity variance. You get your capacity variance. It is actual here, it is adverse here because your budgeted is less than your actual is less than your budgeted, and this is fixed overhead. Regardless of the number of hours they work, you are still going to pay them the amount. So for you to maximize your fixed overhead, you should be able to produce more at the same rate, at the same amount. Do you understand? That is um how to maximize your fixed overhead. But here now you see that they produce less than your budget and are still going to pay like the same amount. So that means you are not really getting the value for the money. So another thing is for your efficiency. Efficiency is your standard hour minus your actual hour multiplied by standard rate. So what I'm not saying is if you the two answer you get in capacity and efficiency must be equal to the answer you are getting in volume. So when you have adverse 8,140 and favorable 6,290, when you net the two off, it gives us 1,850, and that was what we tested. Yeah, and we had 1,850. Around 1,850. So I can move to sales. Sales. So I said sales is a function of volume, and volume is equals to standard quantity standard quantity sold projected quantity sold actual quantity. This is 5,001. This is 4,850. What's the difference?
250.
Now, I am using standard profit because we are assuming that we are using absorption costing system. We are using our
6.
absorption costing system. And absorption costing system is the system that treats fixed costs, or that treats rather overhead cost as a product cost. As a product cost, I think I explained that yesterday. A product cost, fixed overhead sees our overhead as a product cost. It is absorbed into the cost of a product. While marginal sees it as what? Sees overhead cost as a prior cost. That is a cost that will be written off in the year it was incurred, to be written off in that period directly. So we are still going to do a reconciliation on marginal using this same question so that we can save ourselves the time. So we can save time. So what is standard profit in the question?
6 naira.
Standard profit is what?
6 naira.
What standard profit?
6 naira. 6 naira.
Standard profit is 6. So when we multiply it,
1,500.
this is 1,005 advance. Yes, it is advance because you plan to sell 5,001. You plan to sell 5,001, and eventually, you sold 4,850. As a good business person, are you going to be happy for that day? Do something that will make you happy for that day? No, because you sold less than what you've budgeted, and as such, it is what? It is adverse. So we have done volume, we are doing price. So for price, and the formula is standard selling price minus actual selling price. We will get the difference multiplied by actual quantity sold. Standard selling price is what?
20 naira.
What is standard selling price?
20.
What is standard selling price? 20. Then the actual, they said we sold 95,600. We sold goods worth 95,600, and the unit that was sold was 4,850. So what is the cost by what is the selling price per unit?
19.7113.
19.7113. So I'll just, like I said, I'll just do 20 minus answer so that I'll be on the safer side. I will not be. Actual quantity sold is 4,850.
1,400.
This is 1,004.
Money. God.
4,004 advance. Yes, advance because The standard selling price is 20. The actual you now sold is less than 20. So this is sales now. The rationale behind arriving at favorable adverse won't be the same thing. So I can now move on to reconciliation. Reconciliation. To get my reconciliation, I'll get my what is my budgeted profit. Budgeted profit is equal to my standard profit per unit multiplied by budgeted quantity. So the standard profit per unit is 6. Why this is 5,001? So what do we have? The budgeted profit is 51 times 6, 3,600.
30,600.
And what is the actual? Actual profit is going to be sales. Sales is what? 95,600. Cost of production. So cost of production. What is the cost of material? What is the cost of material?
2 naira.
Actual cost of material. Actual cost of material is 9,600. 9,600. Labor. 16,800. Variable overhead. 2,600. Fixed.
42,300.
42,300. Oh, so that reminds me, we did not do idle time. So for idle time is going to be idle time multiplied by standard rate. What's the idle time? Idle time is the actual hours worked for, which is 8,005
8,500
minus
minus 8,000.
8,000 You give me 500. The standard
Two.
rate.
Two.
Standard rate is what?
Two.
So this one gives me what?
1,000.
1,000. Because there is no standard or budgeted idle time. So I told you it's going to be adverse because I'm wasting things going. So what do I have as total here? Now in this case now there is no closing stock. If there to be closing stock, we would have valued that closing stock using standard cost per unit. But since all the quantity that were sold, that were bought were sold, so if in a situation you have closing stock, you are going to value it as standard cost because you have to use you have to deduct the cost of the number of goods you sold from its sales. You can't say you produce 1,000, you sold 900 out of it. You now want to deduct the cost of 1,000 from the sales of 900. No, it does not work like that. So if you are supposed to, if you are giving inventory, closing inventory, you value it at standard cost. So the total here is going to be what?
Material cost should be 9,800.
Huh? Material is 98
Yes.
to 71,500. So profit
24,100.
24,100. Now you see that the profit you budgeted is 3,600 while the actual profit is what? 24,100. What has happened? The variances has made your actual profit less than your budgeted profit. Now what is the difference between the two? The difference in profit, let's say is equals to this 6,005. It is adverse because you actually got less profit. So I will now come here, I will say particular and call this F, call this A, favorable and adverse. Now we want to investigate if our difference in profit is actually caused by all the variances we've been calculating. If the profit has been caused by all the differences, if the change in profit or reduction in profit has been caused by our variances. So we have sales volume, we have sales price, we have material price, We have material usage. We have all the variances we've computed. We're bringing it back. We want to bring everything out. The one that is favorable, put it under F. The one that is adverse, put it under A. Labor efficiency, variable, expenditure, efficiency. Fixed overhead, expenditure and volume. So all the variances we've been calculating, we are going to bring it out here now. Okay. Material price volume,
Or
sorry, sales
sales
volume.
sales volume
Eh?
1,500 adverse.
What about price? Price is 1,400.
1,400 adverse.
Material price variance.
600 adverse.
What about usage?
500 favorable.
500. Labor rate.
200 favorable.
Labor efficiency.
3,400 favorable.
3,400.
Yes, favorable. Favorable.
Labor wide expenditure.
200 adverse.
Okay. Efficiency.
510 favorable.
Four.
510 favorable.
So I didn't get that.
510. 510.
So let me check. 510. Okay. Expenditure.
4,560 adverse.
4,560
4,560.
advance. Okay, this is 1850.
You skipped the labor idle time.
Eh?
Labor idle time.
Idle time, that's true.
200. 1,000. Sorry.
So when you get the net effect, you can see that the difference in your profit is caused by all the variances you've been calculating since. And that is the way, if similar question comes out, this is the way you should check if your solution is correct or not. That is it. Because you are saying that the way you've planned your things did not work out the way you've sketched it out, which simply means that it's all these variances, all this deviation that has caused things not to go the way you want it to go. You wanted to buy material has increased up. It causes a variance of 600 adverse. That means it has gone up from your standard, from the standard. And also the usage, you are using 500 worth of material less than what you should be using, although you are saving cost. Yeah, labour too, you saved 200 naira in labour rate, $200. For efficiency you save 3,004. So all of these things are going to have negative and positive effect on your standard projected profit. But you have to look at, there is negative effect, there is positive effect. You have to look at the net effect between the two, and look at the net effect here. It's giving us also the effect here, which is the difference between standard profit and projected profit. Any question? Any question? Please, I will be entertaining question. Please, question. So budgeted quantity is 5,001, actual quantity is 4,850, then the difference is 250, while the standard contribution, we have 2 plus 4 plus contribution. Then we have material. Material is 2, labor, think labor cost is 2, payable overhead is 0.6. The total of this is 2.6. Sorry, 4.6. So the contribution is going to be this minus this. Oh, sorry, I didn't share my screen. I am solving the same question using marginal approach. I am solving the same question using marginal approach. I am solving same question using marginal approach. Ah, same question using marginal approach. So I said, I hope you get my explanation. So this is what I've done. Uh, just that you could not see my screen. So are we there? I think I've used the wrong figure here. This is 2, 4. This I'm having issue with this getting going to the question back to. So this is 6.6. So the new sales volume variance is going to be 13.4. 13.4. So 250 multiplied by 13.4 is 3,350. So this contribution I got now, look at how I got it. I can also use this other approach I said, that profit, fixed cost, add profit, because we have profit here. When we use the same approach, fixed cost here is 7.4, 7.4. Then profit here is, what's the profit? The profit in the question here is 6. 6. So we are still going to have 13.4. These are the diverse ways these are the diverse ways we should look at things when you are solving questions. So we have this. So we are going to compute our actual again. So if to save time, I will be copying this actual profit. Now the fixed cost won't be there because it will be treated as period cost. Are we still together? Can you see the screen now? Please, can you see the screen now? Kindly indicate if you can see the screen. Indicate if you can see the screen. Okay, so you can see it now. Okay. Okay. So using the marginal approach now, we have gotten the actual profit to be 66,400. 66,400. So what we are going to do now, contribution rather. This is contribution. So actual budgeted contribution too. The budgeted contribution now is now going to be standard contribution multiplied by budgeted quantity. Standard contribution multiplied by budgeted quantity. Standard contribution that I got here, which we use two methods to get. We said sales minus variable cost or fixed cost plus profit. We had 13.5, 13.4 rather. So this is 13.4 multiplied by 5,001. We are really behind. We should have gone past this. But, so the answer here is 68,340. Please, I hope you are using your calculator because I'm using my own calculator too here. So that's the budgeted profit. I will now come here to save our time. Let me copy this as well. I'll just change what needed to be changed and I'll explain why we are. Even in exam 2, we are just going to copy and paste also. So my fixed volume, my sales volume has changed to 3,350 advance. 3,350. And I don't need volume. I don't need volume variance. So all of other things I will still need, but I do not need volume variance. All of that thing I will still need, but I do not need volume variance. I do not need volume variance. So we try and get the net effect here. The net effect here is 13,000. Let's see if the net effect here is going to be the same thing. The net effect Okay. I'm sorry, I'm in a network disadvantaged area. So I've gotten my, okay, I copied. I'm supposed to get the contribution.
You know they get. Alice, you know they are.
So this is the sales, and we said the actual production is 4,850, 4,850 multiplied by our contribution 6.6. So what will this give us? This will give us 4,850 times 6.6, 32,101. So when we deduct it, we have this minus, so we have 6590, we have 6590 3590 minus 68 340. So please, you can use the other question for the marginal approach. I don't think this question is actually meant for that. So let's stick to this. We use the next question for marginal approach. I wanted us to use one stone to kill two birds. Tell us use one stone to kill two birds. So I hope we are clear on this. I hope we are clear on this. I hope we are clear on this. Please kindly indicate so that we can move on.
This place now, this from the they work for you. Have you not trust us, say we will do less than. Why you don't dey stop class midway? What is the one individual amount? Okay, where your Wi-Fi? You get one two one, you don't how much is the subscription? Maybe 5,000. If you was watching the modern, you Okay, well, so make I keep am for your room. You come anytime for next 2 hours.
If you can hear me clearly, kindly signify so that we can continue. At least finish this up. If you can hear me, kindly indicate, please, so that I can move on, so that I will know those that can hear me. Okay, so please, what we've done to that extent, do we understand to the absorption method um before the network started messing up? Do we understand? So that I will just continue from the next question. Please, do we understand? It is important that we do we understand? Okay. So let's look at question two. Let's take a look at question two. So this question two is actually a past question. It's actually a past question from it's actually a past question from I think it was 2019, number two. It is so they said tomato paste Nigeria Limited produces tomato paste which serves as an alternative for an immediate stew for working mothers instead of looking for fresh tomatoes. For the forthcoming period, the company's budgeted fixed costs were $600, 600 naira, and budgeted production and sales were 13,000 units. The product has the following standard cost: selling price, material, labor, variable overhead. Actual results for the period were as follows: 11,000 units were made and sold. Earnings revenue of 5,720,000. 660 kg of material were bought at a cost of 2,970,000, but only 63,000 kg were used. 36,000 hours of labour were paid for at a cost of 1,422. The total cost for variable overhead was 1,170,700 and fixed costs were 400,000. Fixed cost was 400,000. Okay. The total cost for variable overhead was okay. The company uses marginal costing and value all inventory as standard cost. The company uses marginal costing and values inventory as standard cost. Required: prepare prepare a statement reconciling actual and budgeted profit using appropriate variance, 12 marks. We calculate the fixed overhead cost assuming the company uses absorption dis assuming the company uses absorption costing. Discuss possible causes for labour variance you have calculated. So now look at dis question. Dey say prepare statement reconciling actual and budgeted using appropriate variances. Using appropriate variances. Using appropriate variances. E didn't tell us to compute a particular variance. E didn't tell us to calculate a particular variance, but we were told to just calculate all relevant variance. Now, in dis case now, the relevant variance available here, you can calculate sales variance, material variance, labour variance and variable overhead variance. So let's start. Let's start on a new sheet. We have for material is divided into price. So for price we have what is the for price we have standard price minus actual price, the difference, then actual quantity purchased. You can see the difference between actual quantity purchased and consumed in dis question. You can see that it's not the same thing. It's not the same thing at all. It's not the same thing. So So the standard price per unit is 40 naira per kg. Standard price is 40 naira per kg. Standard price is 40 naira per kg. The actual price, you don't know the actual price. Just give me a moment. I want to look for the question on my phone. So actual price, yes, I've gotten it on my phone. Actual price is that the material of 66,000 kg was bought for 2,970,000 divided by 66. 2,970 is 45. And the actual quantity purchased is 66,000. So 40 minus 45, this is minus 5. Minus 5 times 66. This is 330. The material price variance is 330 adverse. 330 adverse. The material usage variance usage is standard quantity minus actual quantity multiplied by standard price. So the standard quantity per unit is 5. It's 5. Standard quantity per unit is 5. Is 5. Then how many units were produced? 11,000 units were produced. And how many units were, how many kg rather, how many kg were used? 63,000 kg were used. This is 55,000, but the standard rate is 40. Standard rate is 40. So when we deduct this, 66 minus 50, 63 minus 50. This is 8,000. 8,000 times 40, that's 320. 320. I hope we are together. I hope we are together. I hope we are together. Oh, I'm not sharing my screen. This is adverse. Adverse. So we can move to labor. Labor. So for labor, we have the rate, which is standard rate, and actual rate. Actual quantity is, so what is the standard rate given in the standard cost card according to the question is 40 naira per hour, while the actual rate, we were given that labor were paid 1,422,000. How many hours did they pay for? 36,000. 36. 36. 1,422 divided by 36. 39.5. 39.5. And this is 0.5. actual hours rather paid for, actual hours paid for is 36 hours. So 36 hours, that's 18,000. 18,000, is it favorable or adverse? 40, 39, that's 40, 39, that's favorable. Favorable. So we move to labor efficiency. Is where you don't understand, please let me know. This is one of Ican past question, 20 marks. I've shared the screen. So we have the standard hour minus the actual hour difference. Then we have the standard rate. This is 5. How many hours is required per unit? 3 hours. 11,000 units were produced. Then the actual is 36 hours. And the standard rate is 40. Thirty-six thousand, 33,000. This will give us minus 3,000 multiplied by 40, which is the standard rate. What do we have? 3,000 times 40, that's 120,000 advance. So that is all for labor. Then we'll move to overhead. Please, you can keep dropping your question. I'll attend to them as I check the comment box. So for variable overhead now, variable overhead is expenditure, expenditure. So for expenditure, we have standard rate, there's actual rate. Get the difference, then we have standard actual hour. So standard rate for variable overhead is 30. The actual is that 1,170,000 was paid for variable overhead, and how many hours were worked. Number of hours worked for and hours paid for were the same thing for actual, which is 36,000. So I'll check my calculator. So I have 32.518. Like I said, you have to make sure you don't just approximate anyhow. You have to pick the figures and just say so the difference is going to be this minus the answer. Please make sure that is what you do in exam, so that multiply by 36,000 is 9,700. 9,700. 9,700. This is 36,000. Then expenditure, efficiency, standard hour, actual hour. We have the difference. Actual hour, standard hour, then we have the standard rate. So here now, what's the standard hour? Standard hour per unit is for variable variable is 3 hours. How many units were produced? We produced 11,000. Actual unit produced 11,000. 33,000. The difference is 3,000. The standard rate of variable overhead is 30. This is going to be 90,000 advance. So since we are doing marginal, we are not going to prepare for fixed overhead, but rather we go to what? We go to sales directly. So for sales, I have volume. Let me start with price. Price is actual price, standard selling price, and the actual selling price multiplied by actual quantity sold. Actual quantity sold. So the sales, the price, standard selling price is 500. Actual selling price, actual selling price they gave us the total sales to be 5,720, which we are going to divide by the number of units they sold to get the unit price. Divided by 11. So that is assumed that 30 will cancel 30 divided by 11. I have 520, 520, and this gives me 20 favorable. Actual quantity sold is 11,000. The variance is going to be 11,000 times 20, and this is 220,000. That's 220,000. So now we move to volume variance. Since we are using marginal, we are not going to consider profit now. What we are going to consider is contribution. So we have standard price, standard sorry, budgeted quantity minus actual quantity to get the difference. Then we have standard contribution. The budgeted quantity is 13,000. Actual quantity is 11,000. This is 2,000. Now the standard contribution we have the selling price to be 500. We have the material to be 200. We have labor. Labor is 120. The variable overhead. Variable overhead is 90. So when we deduct say 200, the contribution we get is 90. That's our contribution. 90. This is going to be 180,000. Advance. Should be advance. 90,000 advance. Price here is favorable because you sold more than standard price. Yeah, you are selling more than the budgeted. So you can now come here and say particular. So let's calculate the budgeted profit. Budgeted profit. Budgeted profit is going to be what our standard contribution. Standard contribution is 90. So we just say standard contribution, which is 90, multiplied by how many units we budgeted to produce 13,000. So this gives us 1,070,000. So we deduct the fixed cost for the period. Fixed cost, budgeted fixed cost, which is 600. So the profit here is 570,000. So can now come here to calculate actual profit. Actual profit. What is the sales? Sales is given as 5720. Material the material we bought, we didn't use everything, so we can't calculate everything. So what is the actual price of material? You have to get the actual price of material. Actual price of material per unit is 45 naira. So we just multiply that 45 naira by the number of material that was consumed. The number of material that was consumed was actually 63,000. 63,000 times 45. But that is what we are. That is what is it 45 or 40? Yeah, it's standard by the standard price. But we say our standard cost is used to value inventory. So we say 63,000 by 40. No, sorry, this should be 45. Okay, so let's do it this way. The cost of material given to us is 2970. 2970. We can now come here and less the closing inventory. So the total inventory is 3,000 at 40 naira at standard cost. 3,000 at standard cost. This is 2970 less 120,000 from it. Then labor is 1422,000. Have the variable overhead. Variable overhead. Variable overhead is 1170.7. We have the fixed overhead too. Fixed overhead of 400. 400. So you can now deduct all of this. So what we get here, 5842.7. So we're deducting the cost from, so the total here is going to be 570 minus 5842.7. And this is a loss of 122.7. That's a loss of 122.7. A loss of 122.7. So I'll come here and say sales volume for the particular is still the same thing, sales price material price, material volume, material price, material quantity rather, quantity or usage, labor rate, labor efficiency, labor rate, labor efficiency, then variable, have the expenditure and efficiency. So we have the favorable and the adverse. I hope we are still together, please. So you are getting 544.2 instead of 48.2. Where? So this is what you will do. You are going to say 2970 minus 120,000, which is 120, plus 1422 plus 1170.7 plus 400. Can you do it again? Do it again. Can you do it again? So for the sales volume, sales price, we got 220 favorable. Material price, we got 330 favorable. Material usage or quantity, we got 320 advance. Labor rate, we got 18,000 favorable. Labor efficiency, we got 120 advance. Variable by expenditure variance, the advance 90.7, and efficiency 90. So the total, so I have to use the formula because get what do we have when we have the next when we get the next effect. To be equals to this. So we have gotten the actual profit, gotten the actual profit. I've gotten the projected profit too, and this is the variance. Do we have any question? Yes, yes, yes. Not a million, it's in thousand. It's in thousand, not a million. It's in thousand, not a million. Material price. Material price. Yeah, it is in advance. It's advance. So it's in advance. So any question? Yeah, I've changed it. I've changed it. I've changed it. Any question? So any question? So we can actually move on now. Do we go for a break now? And we resume around by 3 or 4. I was supposed to go on a break by 3. But do we go on a break now? Then when we come back, we finish up on standard costing. We'll do operational, we'll do mix and yield, then we'll call it we'll cap it on, on standard costing. So this question we're actually solving now is um, um, November 2020. November 2020, question 2. November 2020, question 2. So what time do you suggest to come back? What time should we come back? What time should we come back? Okay, you're welcome back. You're welcome back. So I we have been able to solve basic variance. We've been able to solve basic variance, and now we are moving to something called mix and yield variance. After that, which we are going to go into um, operational operational and planning variance. Operational and planning variance. After that, we we call it a topic on this. Now, I want you to pay attention to details as we go into this topic, because as you all know, this class is just meant to be a revision class. As much as we've not had a smooth learning class like I we would have wanted, at the same time you have to bear with us. You have to bear with us. You have to bear with us. So there are some things I would like to tell us before we start, and which is the fact that one, we have to take this we have to take this thing up. Since we've signed for this diet already, we have to take it up and go extra mile as well. All of these are just to teach us the basic few things, and it would have been a different ball game if this class was had been a physical class. Oh God, we would have really enjoyed us more than this. But we still have to work with what we have. Now, mix and yield. What is mix and yield? Mix and yield is a subvariance of material usage variance. It is a sub of material usage variance, and mix and yield is usually considered or computed just for management purpose, and in a situation whereby influence management can influence things. Management they have control over how they mix product, how they mix ingredients to become a product. So now I'm going to give us an illustration, an example of how many of these things, how we can relate many of these things. And number one is that, take for example, when take for example, you have um you have a product you want to sell, and each product, to produce 1 unit of that product, you need honey and sugar. Let's say you need honey and sugar. You know by default that sugar is more expensive than honey. Sugar is more expensive than honey. So maybe because you want to save cost, you now be like, oh, okay, let's say sugar should be 3 teaspoon of sugar and 4 teaspoon of honey. But because you want to save cost, you now increase sugar to be 5 teaspoon. You reduce honey to tea 2 teaspoon. Now, what have you done? You have reduced cost, but you have not gone with the standard mix of those ingredients to produce that product. So what are you going to have eventually? Then you should be expecting something that is below standard, something that is not of standard. Yes, that is what you should be expecting, because you have not gone according to the standard mix of that particular product. You've deviated because you want to probably save cost. Now, this is also a formula thing. It is a formula thing, and I'm sharing my screen to for access. sharing it for access. So it is a formula thing. It is a formula thing, and I it is just best we look at question. It is best we look at question to be able to solve any question on mix and yield, on mix and yield. So let's look at one of the questions we have there. Let's look at some of the questions we have there. So let's look at this question. Let's take a look at this question. Let's take a look at this question. Let's take a look at that question. They said a company manufactures a chemical, dynamite, using two compounds, flash and bang. They have a company manufactures a chemical. The name of the chemical is dynamite. They said using two compounds, flash and bang. The standard material usage and cost of unit of dynamite are as follows. We have flash, bang. In a particular period, 80 units of dynamite were produced from 600 kg of flash and 750 kg of bang. So these are the actual results, the actual unit, the actual kg of flash and bang that were used. Required, calculate the material usage, mix and yield variance. Calculate the material usage, mix and yield, variance. Now let's start. Let me write the formula out. Material usage. Please, in exam, while you are doing exam, please don't do the two. Just do one of it, either material usage or material mix and yield variance, just one of them. So we have for product, we have A and we have A. So we know the formula to be standard usage or standard quantity minus actual quantity, get the difference, multiply by standard price. So what is the standard quantity of A? The standard quantity of A so let me change to Excel. Let me change my screen to Excel. The standard quantity of A is 5 and the unit of dynamite actually produced is 80. Is 80. So I'll say 5 kg standard kg per unit, 5 kg multiplied by 80, while the actual is 600. So this one here will give me 400. Here's my calculator. This is 400. This is 400. So when you get the difference is minus 200. Minus 200. And the standard price of material A is 2. Standard price of material A is 2. So the variance is going to be 400 adverse. The same thing goes for B2. For B, standard quantity, actual quantity, the difference, and multiplied by the standard price. So, for B, we have the standard quantity per unit to be 10. Actual quantity is actual quantity produced is 80, while the actual usage of bang is 750. 750. So this is flash and not A, and this is bang and not B. So we have 10 kg. 10 kg multiplied by 80. Upper quantity is 750. 750. This is 800. The difference is 50 positive. 50 positive. While the standard rate here is 3. So the difference, the variance here is going to be 150 favorable. 150 favorable. 150 favorable. 150 favorable. So we can now move on to mix and yield. That mixed variance. Material, flash, and bang. We have actual quantity at actual mix, actual quantity of material at standard mix. We have this standard price standard price, then we have variance. So what this one is actually asking is, what is this actual quantity and actual mix? It's talking about how have they eventually mixed that product? How have they been able to use that product? What is the actual result of mixing that product? And here is it. You'll be given directly in the exam. And this you'll be given directly in the exam, which is 600 for flash and 750 for band. Add the two up. Add it up. Add it up. We have 1,350. Now, this 1,350, we now want to share it according to the standard mix. We want to see how we would have mixed it according to the standard. We have used 1,350. Now, we want to look at this actual quantity, how it should have been mixed ordinarily if we are to go by standard. How it would have been mixed if we are to go by the standard. So if we are to go by standard, it should be 510. For 1 unit of the dynamite, it should be 5. And for 1 unit of that dynamite, you are going to use 10 kg of bang. So this is what we will do. This is what we will do. To get for flash, it's going to be flash is 5 plus 5 over 5 plus 10 multiplied by 1,350. Then for band 2, to share is going to be 10 over 10 plus 5 multiplied by 1,350. So what we have here is 5 over 15 5 over 15 multiplied by 1,350. And here is 10 over 15 multiplied by 1,350. So 5 divided by 15 multiplied by 1,350 this is 45, 450 rather, and this 10 divided by 15 multiplied by 1,350, this is 900. So I write it out here as I shared it, 450, 900. Now, still give me 1,350. Now, I was supposed to mix by standard 450. If I was supposed to, this is it. Let me come again. I produced 80 dynamite. According to that 80 dynamite that I have produced, going by the standard mix, I should have used 450 kg of flash. Going by the 80 unit of dynamite that I've produced, by standard, I should have used 450 kg, but we eventually used 600. That means we have overused that material by what? by 150 already, by 150 already. Now, we're supposed to use 900 to produce 80 units of dynamite, but we used 750. That means we have short used that material. We have underused that material by what? By 150, which is what? So the standard price is still 2. Standard price here is still 3. So when we multiply it, we have 300 adverse, then we have 450 favorable. When the two net off each other, we have 150 favorable. We have 150 favorable. I hope this is perfectly clear. I hope it is perfectly clear. Okay, so we move to yield variance. We move to yield variance. So for yield variance, we have the material also, flash and bang. We have the flash and bang. So for this, I I have actual, quantity, at standard mix. Then I have standard quantity at standard mix. I have the difference, standard price, and we have the variance. So we already calculate the actual at standard mix, which we got 450. And Can you hear me now? Ah, God. So I have sales mix variance. So for the sales mix variance, we have product, we have actual sales at standard mix. You can also take at actual mix. Anyone first? Any which one? Actual at standard mix. We have the difference. We have standard profit. We have variance. So we have product chocolate and strawberry. Chocolate and strawberry. So the actual sales into actual mix of chocolate is 280, while this is 630. When we add this together, equals to this plus this. So now, how have we been able to use this 910 if you are to go by the standard or budgeted? Your standard can take place of your budgeted here in sales mix. How should we have used it? It would have been for chocolate, it would have been 300 over 700 multiplied by 910. Then the same thing applies to strawberry. It's 400 over 700 multiplied by 19. This is 390, 390 here. And here this is 400 divided by 700 multiplied by 19. This is 520. 390, 520. Standard profit. Standard profit here is 2000 divided by 400 is equals to 50. And the standard profit here is 900 divided by 300, which is equals to 80. Sorry, 390, 520. Still gives 910. Gives 910. And for the variance, I'm going to say, let's get the difference first. Which question? Mr. Chris, which question? Mr. Chris, which question? You know what? Just let's finish. I will go back and explain how I got to that extent before you join. Let's let's finish it first. I'll soon be done with it. So the actual into actual mix is 280, while the actual standard mix is 290. So we have 280 minus 290. 280 minus 390. This is 110 adverse. Why 630 minus 520? This is 110 favorable. So when you multiply 110 times 50, you have 5005 adverse, 3003 favorable. And the net effect here is 2002 adverse. So we move on to do you sales quantity variance. Sales quantity variance. Sales quantity variance, we have products, we have actual sales, and standard mix, standard budgeted sales, at standard mix, difference. We have standard profit. Situation, they might tell you some situation, they might tell you to use standard contribution. I'm going to send a question like that to the group. Standard contribution, then variance. Just use standard contribution in place of, so you have chocolate, strawberry. This is 390, this is 520. So it's budgeted as standard mix. Just take what you have in the standard cost card, the 400 and 300. Just take it direct. You don't have to really complete anything. 300 and 400. So here we have 90 favorable because it is actually higher than the budgeted. Your actual sale is higher than the budgeted by 90. And here we have 120. 120 favorable to 120 favorable, which is multiplied by 50 standard profit and 30 respectively. This should give me 4,005 favorable, and this should give me 120 times 30, 3,006 favorable. So 36 favorable plus 4,005. That's 8,001. 8,001 favorable. So let me compare and see. For chocolate is 3,000 favorable. 90 times 50, 4,005. So something is wrong somewhere. It should be 5. So this is 600. Two 80 and 390. So 110 multiplied by 5 as 550. Let me go back to the question and say this is 5. Related quantity Oh, this was supposed to be 400, 300, and not the other way around. It should be 400 and 300, and not the other way around like this. So this one should be 520, and this should be 390. I'm the one doing everything, so and there is no light here, so I just have to. This is 520, 390. It's going to be 240, 240 advance, 240 favorable. So 240 adverse times 5. This is 1002 adverse, and 240 favorable times 3. That's 3006 favorable. So when you net it, this is 2004. 240 times 3, 720 favorable. 1002 minus 720. This is 480 adverse, 720 favorable. So the same thing here, it goes up to 390. So here it's going to be 220 favorable and 10 adverse. 220 times 5, 1001 adverse, and 30 favorable. So it's 1000 favorable, sorry, F here So any question? Any question? Before I go back to where any question? Any question? Explain which one again. Okay. So the sales mix variance. So for the sales mix variance, the formula is the actual sales and actual mix, and we have the actual sales as standard mix, the difference and the standard profits. Now, the actual at standard mix has been given to us as 280,630, while the actual at standard mix, we have to calculate it. Now we've gotten the actual sales to be 910. Now we want to divide it according to the standard mix, which is 400 and 700 respectively. 400 and 400 rather and 300 respectively. So the mistake I made was giving chocolate 300 and giving strawberry 400. So I had to recalculate again. That was how I got the 520 and 390. So when I deduct it, I have 240, which simply means that the actual sales as standard as actual mix is less than the actual sales using the standard mix. It is less. Now if you look at this formula now, you will see that what is common to both sides, it is actual sales. When you cancel out actual sales, what you have is what? Actual mix and standard mix. And your actual mix is 280, your standard mix is 520, which simply means that your actual mix is lesser than your standard mix, which makes your sales what? Advert, because it is sales now and you are selling less. It is what? It is it is adverse, and that is the reason we have the adverse there. That is the reason we have the adverse there. Let me even calculate. So I hope I've answered the question. Any other question? Yeah, again. Now I made a mistake again. This should be 400. Please help me check the figure. I'm Please help me confirm the figures. It's becoming too frequent, and this should be 120 favorable, then 90 favorable too. 600 favorable and 270 favorable. Any question? Have I been able to answer your question? Okay. So um the last thing I want to talk about under under standard costing is operational variance, operational and mixed variance, operational and planning variance, operational and planning variance. And I'll be solving the only question that has been tested by Ican. So far, they've tested only one question in this um, on this planning and operational variance. But if you look at it very well, let me just quickly explain in 5 minutes. If you look at it very well, you are going to see that um, we are setting our standard on one premises, which is maybe past event. Now, it is important also that we revise our standard often, maybe every 2 2 years, every year, but not so not all the time. No. Why? Because we might be working with an unrealistic standard. Then we'll keep having a large variance. Then you'll be like, why are you having such a variance? It's because things have moved on from what they used to be initially to what they are now. Now, it is our responsibility to come up with a revised standard, a standard that will be that will consider, that will put into consideration, um the realistic estimate. Now, now operational and planning variance has now come in place to be able to see, why are you, if you are having such an unrealistic standard, why not come up with a new standard and see how it works, and see how it goes, and see how it goes. Now, planning variance, for us to be able to get well, the planning variance is just a difference. Planning variance is just the difference between original standard and the revised standard. Now, if you know the previous formula I gave in the morning, wherever you see actual, just put revised there. That is the variance for revised. Wherever you see wherever you see actual in that formula, just insert um revised there. Just insert revised there, and let's see how, and you see, you calculate the variance normally as you used to calculate it. And when we get to operational variance, that operational variance is where things have started occurring. So the operational variance is now the difference between the revised standard and the actual standard. So you have two standard now and one actual, the original standard and the revised standard. So the planning stage is between the original standard and the revised standard, while the operational stage is between the revised standard and the actual result and the actual result. So now I will go on now to solve that one particular question that has just been tested so far and see how we can go about it. So and that is this question. It said Pestel Limited. This is actually a past question from Ican Park, from Ican Pathfinder. Pestel Limited produces cake and bread which it supplies to a major supermarket in Abuja. It owes no inventory because it adopts the just-in-time system. The standard cost of the wheat used in baking the product is 200 naira per kg. 200 naira per kg. Each piece of cake uses 0.5 kg of wheat. Each piece of cake uses 0.5 kg of wheat, while each loaf of bread uses 2 kg of wheat. Now, two piece each piece of cake, to make one cake you need 0.5 kg of wheat, while for one loaf of bread you need 2 kg of wheat. Can you now see? Now we are trying to um get the question now. We move on. The production level for cake and bread for the month of October were as follows: budgeted production, actual production. Okay. The actual cost of wheat in October was 232 per kg. 964,000 kg of wheat was used to bake the bread and 190 kg was used to bake the cake. The global prices of wheat increased by 18% in the month of October. At the beginning of the month, the supermarket group made an expected request for an immediate change in the cake, resulting in 5% more wheat than previously required. That is, the number of requirement needed for the standard usage of cake per unit has now increased by 5%. It has increased by what? By 5%. By 5% for an immediate shape change to the cake, resulting in 5%. This cake also brought about production delay which caused a reduction in production by 20,000 units of cake in that month. The production director is given the task of purchasing relevant input material and any production request which occur, although he does not take responsibility for setting standard cost required. Compute the following variances for the month of October for each of the products and in total: material price planning variance, material price operational variance, material usage planning variance, material usage operational variance. Now let's go. But before we start this thing properly, let's down do some analysis that will further lead us. I hope we are still together, please. So my original standard for cake is that cake will be needing 0.5 kg, and each kg for the original standard, each kg is sold at 200. Each kg is sold at 200 kg, which gives us 100 naira as the cost. And for bread needs 2 kg divided by 200 also, because the price of wheat is still the same thing. This is 400. This is 400. Then the revised standard, has anything changed for cake? Let's see if anything has changed for cake. The global price of wheat has changed by 18%. So just give me a moment. Let me have light. So they said cake, the price of wheat has changed by 18%, and cake now need 5% more of. So that is just the basic change, no other change there. So for cake here, I would say has changed from 0.5 multiplied by, if something has changed by 5%, it simply means you are going to increase by 5%. That's 1.05 multiplied by price of wheat was 200, but it has increased by 10%, by 18%. That's 1.18. So what do we have? 0.5 times 1.05. That's 0.525 multiplied by 200 times 1.18, 236, multiplied by 0.525 is 123.9. And bread, nothing has changed for bread. Bread is still 2 kg multiplied by the price of wheat has changed, 200 naira multiplied by 1.18. Since they are using wheat for the two, so this is going to be 2 kg, 200 times 1.8, 2 kg multiplied by 2.6. This 472. So now, if you are still with me, please kindly indicate. This is the first of many things to do, and if you've gotten this correctly, you are good to go. If you've gotten this correctly, you are good to go. Oh, you can't see my workings? So concentrated. So this is the first of many things to do to unlock the question. So I have inflated it because they said original standard 5 kg at 2 naira each for wheat. Then for bread also 2 kg 400. Then they said the quantity required for cake has increased by 5%. So I've increased usage of cake by 5%, and also I've increased the price of the wheat. But cake is not changing, and bread quantity per unit needed for bread has not changed. Also, the price has changed. Now, let me bring something here. Quantity produced. I will not keep going up and down. I can just focus from here. I'm trying to navigate the question. The this is 240 and 360. 240 for bread, 240 for bread, 240 for bread, and cake 360. Actual quantity, actual kg rather, of material used, actual kg of material used for bread, actual weight of material used was 496,000 kg for bread and 190,000 for cake. 496, 190. 496 and 190,000. So I can now start. Material planning variance. Material planning variance, which is going to be the difference between the difference between original standard and the difference between original standard and revised standard. Difference between original and revised standard. So let's go. We have original standard price minus revised standard price multiplied by so this for cake. Original standard price, revised standard price, you have the difference, then you multiply it by actual quantity purchased. There's no purchase or consume here, just told us. I am using actual. I am using actual. I only need actual actually. I only just need actual to do anything I want to do. I need just actual. So if you look at it now, the original price of wheat under original price of wheat was 200. The revised is what? 236. The difference is what? 36. And what is the actual quantity purchased? The actual quantity material used for cake. For cake is 190,000. 190,000. So the original standard price. Now, let me just give an illustration again before we move on. It's like you now, before COVID, you used to spend 200 naira to your place of work in the morning. So after COVID, now it has now changed to for you to the standard price or the standard price of bus from your place house to your office is now 236. Now, it still does not mean that there are some times or many a times it still might not be the same thing as the estimate. Many of us have an estimate of transport fare we take to work every day, every week, and every month. So what it used to be before COVID is not what it is now. And even our estimate has changed before COVID to another thing after COVID, and it still does not change the fact that our actual might be different from our estimate. Do you understand? So now it still follow the principle of adverse and favorable. Now your original standard price was 200, but the revised standard price has now changed to 230. It is a what? It is an adverse. It is an adverse. So when you multiply 36 by 190,000, this is 6 million. I hope you are solving it with you too. 6,840,000 adverse. 6,840,000 adverse. The same thing applies here. The same thing applies here for bread. For bread too is going to be OSP, revised standard price, the difference, and the what? Actual quantity purchased. But purchase can be the same thing as consume at times. It can be the same thing as purchase at times. So what is the OSP? The original standard price is still the same because you are using bread 200 to 236. This is minus 236, and this one is 496,000. Please check the figure we are picking so that we will not make mistake. It's 17,856,123. So this is also adverse too. This is also adverse. So we are done with planning variance. We can move to planning usage variance. The same formula we are using applies to labor. In case the same thing applies to labor. It applies to labor too. So we go again. For cake, I would say original standard usage minus revised standard usage, the difference, and I get my standard price. When I get original standard price, I'm sorry, yeah, it was supposed to be revised standard quantity. I forgot, I told you, revised standard quantity. Yeah, so revised standard quantity. Now, if it is a revised standard quantity, how much did they produce? 240 was the actual production. Meanwhile, the revised standard quantity is 0.525. So I will say is equals to 0.525 multiplied by 240 for cake. No, 360 for cake. 360 for cake. That this is planning times 360. This 18,900. 36 times answer. This is 68,400. 680, 400 advance. So I wrote revised standard quantity and we didn't follow it. So here it's going to be 2 multiplied by how many quantity of bread? 240 So here is 480. 2 times 240, that's 480 times 36. This is 17,280,000. 17,280,000. I hope we're on track. 17,280,000. I hope we're on track. I hope we're on track. So we go. So for cake, the original standard usage of cake was 0.5 multiplied by 360, while the revised is 0.525 multiplied by 360,000 too. So 0.5 times 360,000, that's 180,000. 5 for this, 0.525 times 360,000, that's 189,000. So what's the difference? This 9,000. And what's the original standard price? The original standard price was 200. So 9,000 times 200, that's 1.8 million. Original standard price is low. Original standard usage is lower than the revised, and that is favorable. That's favorable. So we have for bread too. Bread too, it will take the same formula. Original standard usage minus revised standard usage. You get the difference, then multiply by the original standard price. So the original standard usage for bread is 2 times 240. It's still the same 2 for the revised times 240, nothing changed. This is going to be 480,000. 480,000 nil. So the original standard price is 230. The original standard price is 200. So the 200 multiplied by 0 will give us nil. So the variance here is what? 0. I hope this is clear. I hope this is clear. I hope this is clear. Please let me know if it is clear or not. Even if it is clear, let me know so that we'll know how we'll know how we're making progress. Ọpẹ́olúwa, Mr. Chris, Ajero, is it clear? Where should I start again? Where? In what area should I start again? We've really gone far. Are you sure you understand? Are you sure you understand? So I shouldn't worry. We should move on. Okay, no problem. Yeah, I'm taking the quantity. Yeah. So I'm done with the quantity for planning. I'm going to the operational now. I'm going to the operational variance now. Is there any way that is not clear to you? There is no point coming here and we'll not be able to maximize our time. Do you understand? So please let us be able to maximize our time together. Do you understand? You have something to do, you have an opportunity cost, also I have an opportunity cost. So it is just so good that at the end of the day, if all these things come out, it's going to be a cheat for us. Going to be very, very cheap for us. Do you understand? So that is the that is the goal. Okay, now so we have the operational variance. Operational variance. I'll do for cake. And the operational variance now is now between the standard, the revised standard, and the actual. So here I go again. It's now going to be revised price is going to be revised standard price minus actual price, you get the difference, then you multiply by actual quantity. So what is the revised standard price is 236. Then the actual 236, and then the actual is 232. The actual price is 232. So the difference here is just 4. Then the actual quantity for cake, actual quantity used for cake is 190,000. 190,000. So 190,000 times 4, that's 760. So look at it, your revised standard is 236, your actual price is now 232. That means you are buying below the revised standard, which is a favorable variance. Then we go again for bread. Revised standard price, actual price, the difference, and the actual quantity. The revised standard price is still 236. Actual price is still 232. Difference is 4, while the actual quantity here is 496 for bread. 496,000. So 496,000 times 4, 1,984,000. So that's it. So I have the last one, operational usage variance. So for cake, we have the revised standard usage and actual usage or quantity. You get the difference, then the standard, revised standard price. We used to use original standard price before, but in this case now we're using the revised standard price. So now we have the revised standard usage is 0.525 multiplied by how many units were produced, how many units of cake were produced, 360, 360,000 and actual quantity of material for cake that was used is 190,000. So here is going to be 0.525 times 360. This is 189,000. This is just 1,000. Multiply by 1,000. Divide standard price is 236. 1,000 times 236. That's 236,000. So for bread, divide standard usage, actual quantity or usage, you get the difference, then the revised standard price. So for bread now, it's going to be 2 times or 2 multiplied by 240. This is 480,000. 480,000. Then the actual quantity that was used for bread is 496,000. So 480 minus 496, this is 16,000, right? 16,000 advance. And the revised standard price is 236. This is 3,776,000 advance. Here is, what do I have here? 189 revised, 190. This is also advance. So this is the solution, and the question is just 15 marks, 20 marks rather. And this is the only time that this question has been tested so far in the Ican part. This is the only time it has been tested so far in the park. So I hope we've learned one or two things today. We're supposed to start capital limiting factor and solve last diet question and one other question like that that is exam related. But because of our time, we'll take a break till tomorrow, and I will communicate the time. If I are to schedule tomorrow's class tomorrow, I'll communicate it on the group. You can reach you can reach if you are not on the group, you can actually reach me on, I will display my number on the screen now. If you want to if you want to reach me. So, and as you can see, you are logging in through the accounting media. Now, this accounting media is a YouTube channel that provides that prepares students for ACCA exam, ICAN exam, and some other exam too. So just do well by subscribing to our channel and get um, a notification whereby whenever a video is being uploaded. Hopefully you are clearing this stage and you are going to find out you'll be needing to do SFM, CR, and the likes. There are so many more. And some people that are still writing FR, maybe they are splitting their papers. If you check the accounting media, you are going to see that there's even videos on financial reporting, on accounting standard also, to help you prepare for exam. And I can tell you for free that when you check it out, you are going to see. And if not for the network issue we've been having, which we did not expect and we are not really happy with, we really hope to serve you better than this. But as you all know, it's a limiting factor that we have to cope with, and it's beyond our control. So if you probably need to reach me personally, I'll be here for you to answer your question before tomorrow when we resume. And since we cannot take up all the whole classes again, we have to have an alternative opportunity course for some topics. So I'll be putting a throwing it to us to kindly vote for any topic that you think we should do tomorrow, either between um transfer pricing or short-term decision making, which include limiting factor, linear programming, throughput accounting, or we do this divisional performance, which include residual income, return on investment, and economy value added alongside transfer pricing tomorrow. So I'll be whichever one you think we should do, just let me know. So we are going to vote that out, and hopefully we'll get enough we'll get vote from people. But even at the same time, when you have any question while you're solving, even on topics that we did not do together, you can send your question. I'll be glad to help you for your exam. That is not an issue. Send your question across, and I will try as much as possible to be as simple as possible while explaining. So I'm displaying my number for those that are probably just joining the link directly. They don't have the number 0810. So if that is the case,